The only surprise to me was how surprised the markets were.
This was an opportunity for the Fed to kind of recalibrate.
The market had trouble digesting that.
Jerome Powell getting up and saying what he said, and boom, down goes all the speculation.
That's exactly what Fed Chair Powell gave us.
You heard from every Fed speaker at Jackson Hole. You heard from Powell himself.
Didn't leave any opportunity for a dovish interpretation.
Promising to essentially keep rates higher for longer.
Powell did not suggest there's going to be a soft landing.
Let's also talk about Goldman Sachs and where they're staying bullish right now, and it's on commodities. The firm is urging investors to buy commodities now and worry about the recession later, saying most recession risks hitting global markets are overblown in the near term.
The Fed's economic rescue efforts seem to be unsettling the market even more, especially after the central bank chairman Jerome Powell's speech last week. The Dow saw a 3% drop, and even Bitcoin plunged to below $20,000 in an avalanche that seemed to have rocked all assets markets. The experts may just be right that things are likely to get worse for a while before we begin to see significant recoveries. All gains we saw in most markets, and for cryptocurrencies in July, seem to be vanishing this month. This leaves us with a lot of questions. Welcome to another episode of the Wealth Supremacy channel. Before we go deep into the video, take a second to click the subscribe button. Today, we will be listening to Lyn Alden share her macroeconomic analysis, and then what investment strategy she thinks would work best in this period.
One of my themes kind of this decade is that I think inflation on average is here to stay for quite a while. But I've also been reiterating that it's not going to be a straight line, most likely. I mean, the 40s and 70s, you didn't have inflation in a straight line. You had disinflationary periods within inflationary decades. And I wouldn't be surprised to see the same thing here in the 2020s. You can get an inflationary spike, and then you can kind of come back down if you start to suppress demand or you fix some of the supply side issues. But until you actually resolve more completely the underlying problem, I think that it's like holding a beach ball underwater. As soon as you let it go, it's bound to want to come back up. That's kind of the, back in the prior decade, it's like markets had a tendency to want to disinflate just because you had overcapacity, oversupply for oil, things like that. And I think we're in the opposite environment now, where the tendency is to want to inflate because we have underinvested in a lot of real assets. And so even though we might suppress that for periods of time, I think the longer term trend is still, probably higher commodity and higher inflation on average than we had the past decade. And so I had that article about the area under the curve. It was actually a friend of mine in market that made that quote. So I decided to turn that into a piece. And essentially it's the idea that, everyone's looking at the price of oil, for example, and they're saying, is it going to go to 150? Is it going to fall down to, is it going to go back down? And my point was that if you're a long-term investor, it's not really about what oil does in the next few months. Whether it's 150 or not, or goes back down to like 80 is irrelevant. And instead it's about, what is the average price going to be, I think, over the next 5 to 10 years. And so my general theme is that even at current levels, even when oil is at, 90, 100, 120, or if it goes up from there, that is just an ongoing cost for households and for businesses. And eventually you get more and more realignment towards those things. And so, for example, energy pipelines, oil producers, companies like that, even at current price levels and current volume levels with current valuations, they're actually pretty attractive if you look at them out kind of a longer term perspective. And so the challenge with investing in commodities is always that, in the very long term, they're not great asset class compared to what else you get. They're not these like long-term compounders. Disinflation happens more often than inflation. So there are more decades than not where commodities are not great investments. And then even in inflationary decades, you can have some pretty violent volatility among them, even as they outperform. And so I think that having commodities and value-oriented things long-term, this decade is probably going to be very helpful, as it already has been. But I think investors have to be prepared for those huge shocks that can come along the way, those downward moves in what is otherwise like an inflationary structure.
Wall Street analysts are becoming very bullish on the commodities market, and for good reason. We only have to look at the components of the commodities market, which entails oil, precious metals, and food commodities. We can see that these are sectors that need more investments and would likely see significant increase in local production, as these commodities are directly affected by the global events such as the war in Ukraine. The commodities market recently took a dive of about 11%, but still up 16% year on year, which is a better performance than many other assets, even better than cryptocurrencies. with Bitcoin losing over 50% of its value from August 2021 price of $47,000 to its current August 2022 price of $20,000. Short term, the commodities market seems to be indeed safer than most other assets. Goldman predicts S&P GSCI Commodity Index rallying 23.4% by the end of the year.
So I think that there's opportunity right now. I mean, if you go back a couple years ago, we had a lot of monetary inflation that was happening. So the broad money supply went up quite a bit. We saw a pretty broad rise across the board in asset prices. I mean, so it was a very risk-on environment. And with gold investors, it became why own gold when you could just own all these. If yields are low and inflation's high and money's pouring out, why not own stocks, for example? And then now we're in this kind of contractionary period, risk off period. Gold is held up better than the broad stock market, but it's really not done as much as I think people hoped. And I think that's in large part because there's a pretty significant quorum of the investment community that thinks the Fed will hike to positive real rates, that will get inflation back under control. We have a very strong dollar at the moment, so gold has actually done pretty decent if you look at it in say yen or euro terms, especially in a lot of emerging market currencies, but specifically in the dollar, which is unusually strong right now. It's kind of been lackluster. I think one way to look at it is, there's a firm out in Europe called Incrementum, and they actually had a product that was like gold and Bitcoin mixed together, so that investors could kind of benefit from that volatility harvesting, right? Because if generally Bitcoin does better in these rising PMI environments, rising economic acceleration, and gold generally does better in falling economic environments. And you have kind of almost like a fragmentation of what people want to use as like their hard money holding, right? So you have a lot of people that might have otherwise bought gold, buy Bitcoin, but then, it's a very volatile asset. So in other times, some of them might go back to gold. And generally, I think that's kind of the bucket I'm in, where I think if you look at a basket of gold and Bitcoin together, it's actually done pretty well, all things considered. And I think that might be a reason why gold has underperformed, which is that there's so many other assets you can own in that kind of financial oppressed environment, that gold is just one out of many. And what basically gold and Bitcoin have in common is that these are, money that someone can self-custody, for example, that's maybe outside of the traditional system. And so it becomes kind of a competition between those types of assets.
Just as Lyn said, the PMI index strongly correlates with the price index of Bitcoin. The Purchasing Managers Index is a reflection of how well the U.S. manufacturing sector is doing, and somehow, when the U.S. manufacturing sector is thriving, there's almost always a corresponding boost to the value of Bitcoin and other major cryptocurrencies. We have discussed this correlation in one of our past videos. This is why it's important you subscribe and check out our other videos, so we can keep you abreast of all the important updates on the economy and cryptocurrencies. The surge in commodities has seen the US PMI drop, and we've seen a corresponding response in Bitcoin prices too. This is usually a good time to invest in gold, because gold prices surge when other assets are in freefall. The reason is simply investors pulling out of the stock market and putting capital into gold to hold the value of their capital. This traditional investment safety net gold provides seems to be fading off. Despite the economy struggling, gold has not enjoyed the expected increased demand that would increase its value. The 2008 recession saw gold rise by 5% in the same year, and then 23% in 2009, in response to the recession. But despite a struggling economy with indexes same or even worse than that of the 2008 recession, assets have been struggling since the COVID-19 pandemic in 2020, and yet to recover. Yet the price of gold has not increased favorably. A look at the charts shows that gold has only managed to break even since 2020, with a year-on-year loss of 20.9% and a mere 8.6% gain in the last 5 years. Lyn reveals that cryptocurrencies such as Bitcoin are giving investors more options than they ever had, and this is one of the reasons demand for gold has dropped. Lyn also reveals that a mixed portfolio is probably the best strategy right now, as some assets would give a short-term yield, while some others such as Bitcoin have long-term potential. What is your investment strategy? Leave a comment below and don't forget to like and subscribe.